Well, who said investing was a spectator sport? Anything but at the moment. Donald Trump says we're going to close the Straits of Hormuz to everybody else, and so the share markets fall. He says we're going to open them and the share markets rise. And this can all happen in the space of 3 Truth Social posts. Who knows? Well, nobody really, but Sean Peche has got a better insight into this than most people, and he's going to help us through today by giving us an update. We haven't chatted since the conference in March last month, and we'll see what Sean thinks the world's looking like right now. You know, something I've never spoken to you about, Sean, was what drew you into investing. I know that you sat at the feet of the master, Simon Murray, for some years, but what brought you in the first place? What got you as a young man or even a young lad to say, this is where I want to make my future in helping other people to protect their money and grow it?
Alec, thank you. And it's great to see you again. And it actually goes back to when I was at university. My father passed away suddenly from a heart attack. And my mum had had the fortune of a good advisor, and he'd had some life insurance. And so there was a bit of money from the life insurance pot. And the advisor recommended a few funds. And so I was like, what are these things called? Mutual funds or unit trusts in South Africa. That's what they're obviously called. And started digging and thought, oh, this is really interesting. And I bought a JSE handbook and I sort of started going from there. I opened a broker's account. Then when I completed my studies, I went to Deloitte's and I started an investing club. In 1992, I spent a couple of weeks at Cyfrit's Managed Assets, as it was back then, where I had the good fortune of meeting that fine man, Peter Major. And then when that was in 1992, then I was at Deloitte's. I started this investing club and invited people like Pete Major to come and talk to us. Liston Mankies was another guy, one of the partners at Deloitte's, and we would talk about investing. And I kind of went from there. And and obviously I had the good fortune as well of having Brian Hopkins as my accounting professor. And when he used to talk about income statements and balance sheets and cash flow statements, he would use real live companies. So it was a very fortunate time, and a whole lot of things came together, I guess.
And wonderful names that you're sharing there with us. Obviously, we know Pete Major very well. And unlike you, Pete Major will be at the BizNews Investment Conference. I now can disclose it. We've just put that out yesterday, actually, last night. We put in that we're having it in the Berg, 8th to the 10th of August, so back in the Drakensberg. But my friend, Mr. Peche, is going to be traveling around the world. And you're based in the UK, so I suppose we can't begrudge you your summer that side. It doesn't last that long.
Well, look, I saw your list of esteemed guests, and I'm really sorry I'm not going to be there. That Drakensberg, you reawakened my love for the Drakensberg. We never spent many holidays in the Drakensberg, actually, only one after matric, and it was just so magnificent at Champagne Sports. So we've actually been to we went to the Cavern, and I know there's a close link with the golf. The
Cart
golfing,
family, yeah.
The Cart family. And we had a fabulous week there with my my wife and in-laws. So the Drakensberg's beautiful, and I'm really sorry I can't join you this year, Alec, but my daughter is teaching down under in Australia. And so we're going to be heading to Australia for a couple of weeks to go and see her. So it's been a long year without her.
Sure. The families nowadays in this modern age dispersed around the globe, but investments too. We can sit here in South Africa and invest anywhere we like in the world, and many do. So that's why I love to tap your insights, your wisdom. You spend your time looking around all over the world and often come up with some really interesting different parts of the globe that, well, sometimes I hadn't even heard of the countries that you've looked at. And I guess right now, the subject we should be looking at is what's going on in the Gulf. I mentioned that in the intro, Straits of Hormuz. Everybody knows what it is now. Nobody's sure that this war in Iran is how long it's going to last. The punters think it's going to last. It's gone. It's finished already. I see Gideon Rachman, the FT's chief foreign affairs correspondent, wrote this morning that we haven't even got to the peak yet. So what's your reading on this? And actually, does it matter when one invests?
Well, I was actually asked yesterday by a client in an update, and they said, how are you, and I'll use the phrase they use, they said, how are you playing the Gulf of Hormuz? And I said, we're not. We don't invest like that. We're quite different to many in that we're not trying to guess what everybody else is going to do and what Trump's going to do. I mean, not even Trump knows what he's going to do. I mean, the only people who seem to know what Trump's going to do is the people on the other side who putting in those oil positions 20 minutes before the announcement. They seem to be the only guys who know what's going on.
Do you think that's real? Do you think that's
no,
real?
I think it's definitely real. 100%.
Are they telling him what to say then almost?
No, I don't think so. I think he's deciding. And no, I mean, I would be very surprised if it's not true. It's because you see the news on a Twitter feed, but then it actually makes it into some major papers, Wall Street Journal and BBC and all the rest. So I think where there's smoke, there's fire. It's been an interesting year. I just think back to Feb, the world was up, emerging markets up 15%, JSE up 15% in dollars, nearly 16%. And then all of a sudden, all hell breaks loose in March and markets are down 6.5%, JSE's down 17 in dollars, emerging markets 13, quality 8, gold's down 11.5%. And then April market year to date, a month to date is up 9%, JSE 9%, emerging markets 15%. So large cap from start to finish is up 1.9% year to date. Large cap growth, small cap growth up 13%. At one point this last month, Microsoft was down 26%. So it just shows you, Alec, that anything can happen. And the way to survive these crises is to be diversified and to take a longer term view. But you can't decide you're going to take a longer term view and then you say, oh, what's it? I'm going to take a longer term view. And then when it gets a bit hot and in the kitchen, you decide, well, I'm going to leave the kitchen while the kitchen's on fire. And then when and then you come back after it's all calmed down. Well, now the market, I mean, if you'd sold at the end of March when market was down 6% and now the world index is up 9 this month, well, now what do you do? So it's a tricky thing to try and navigate. And if you're doing that based on tweets and headlines in newspapers, I think it's an impossibility.
Well,
so,
Sean, if you're basing it on headlines in newspapers, you're going to have to scratch to find a newspaper in the first place. But I know what you mean. It's headlines generally, and they're flooding us all the time. This man, Donald Trump, though, and I want to get back to what you mentioned a little earlier. We're going to get more depth about the investment opportunities in a moment. But do you think he's also playing it? Do you think he's making money out of the prognostications that he is providing? Because a lot of people are saying that that's part of the motivation.
Well, it wouldn't surprise me. I mean, look at his antics in Bitcoin and crypto. Look at Hegseth and his attempts to buy a large position in a defense ETF just before the war started. This is it's a corrupt administration. Could you imagine what we'd be saying if, we look at the furor around Cyril Ramaphosa and the money in a sofa. I mean, this is on a different league. Can you imagine if the government in South Africa were playing us and saying, oh, well, we're going to change the rules on mining and then change the rules back, and the markets are gyrating, and each time they personally profiting. So I think, I did say a few months ago, from a few of our conversations ago, Alec, that I thought that Trump would be bad for the US in the same way as I said Zuma was bad for South Africa. And I stand by that. And I think what's interesting, yes, maybe this Hormuz, I'm not a geopoliticist, but maybe it's over quickly, but the ramifications won't be. You've got fertilizer and growing seasons, and a large portion of the fertilizer comes from that region, can't get out the straits. That's affecting growing seasons. That's going to affect crops, which is going to affect pricing. Are the tankers going to pay $2 million? Are people going to then try and make alternative arrangements? So it's probably going to lead to higher inflation, which is going to mean interest rates stay higher. Remember, people, certainly here in the UK, people have been forecasting interest rates falling, interest rate cuts. That's unlikely to happen given inflation. And this is at a time when you've got I think it's $8 to $10 trillion of US debt that is rolling, that was 5-year debt in 2020 at interest rates practically naught. Okay. And that debt is now maturing, and they're going to have to refinance it. And they're refinancing it at, well, interest rates over 4% now. So you've got a third of their third of their debt refinanced at much higher rates than historically. So that's going to put pressure. So I think the ramifications are still going to play out. And I think, higher interest rates is a problem for things like private credit. It's a problem for the financing of these data centers. Who was financing a lot of those data centers? The Gulf. Well, what are the Gulf going to do with the US if they're spending a lot of cash repairing some of the damage that's happened because of this war? How are they financing that? I mean, oil revenues are going to be down. So there's lots of ramifications, and there's lots of.
I don't know if you follow football, but something that struck me this morning was the Saudis now own Newcastle United in the UK. They put their best player up for sale. Isn't that interesting?
I hadn't seen that. Very interesting.
Anthony Gordon, they say they'll accept £75 million from Bayern Munich. And it's always the whispers in the wind, isn't it? But getting back to the markets generally and the Gulf and that volatility that you spoke about earlier, if you look through history, Sean, at the top, at the major changes in markets, you always have huge volatility. That's the reality of history. And I'm just wondering if we aren't missing something here, because, and you're a man who looks at the numbers, not the narrative. And the narrative remains, oh, it's okay, everything's going to be fine. Trump knows what he's doing. You can stay invested. It's all going to be good. Whereas the numbers, and I'm talking about the volatility as part of the numbers, are saying something else might be at play here.
I think, Alec, that's quite possibly the case. If you look at the risks out there, private credit and the AI disruption and jobs and interest rates, I've just spoken about inflation and debt, and then at the same time, you have high valuations. I think we need to prepare ourselves for some tough times. If you think that in the last 17 years, Alec, the S&P 500, okay, total return, so including dividends, is up double digits 13 of those 17 calendar years. Okay. And it's down double digits only one. And the prior 17 years, it was up 9 years double digits and down 3 years double digits, a few in a row. So we've had very good times. And if you look at the valuations, it's since 1989, I think it's in the top 5 in terms of PEs. Even the cash flush, we used to think of the big tech companies being very cash flush. They're borrowing money. And so, so I think we've got, at the same time as the world is turning away from the US, I think politically we've seen that. Look at what's happening with Spain, look what's happening with Italy, even the UK, the special relationship seems to be somewhat in tatters, I would argue. So the rest of the world, what is the relationship like with the US and the Gulf? I mean, they're, very disgruntled there. So, and China. So the rest of the world, Trump has alienated other nations politically, but yet it's 73% of the world index. So at what point are investors going to start walking, and moving their money? Now, what was interesting is, and I saw this over the weekend, is that the US Treasury bought some of their own bonds last week to keep liquidity going. So I don't know. It's I think these are all I would say is this is when valuation really matters. If you think about markets selling off, you want to have minimum downside. So yes, stay in the game, but you need to stay in the right part of the game. It's no good staying in the wrong part of the game. And so you've got to watch what downside you've got. Make sure you've got that margin of safety. And there's a very interesting, I'd encourage your viewers and listeners to have a look. There's a thing called the CNN Fear and Greed Index. And what they do is they compile this by using a number of metrics. And it's how far, the volume of shares that are going up versus the volume of shares that are falling, how far the market is above its 200-day moving average, what the ratio of protection buying, so buying put options, what versus calls, so expecting the market to increase. They put all these together and they give you an index. And there's a dial. It's a bit like a scale, and it goes extreme fear, neutral, greed, extreme greed. Well, we're in the upper, after the last month, we're in the upper section of greed, almost extreme greed. A month ago, we were extreme fear. Okay, so you've got to always ask yourself, if you're not sure, what emotion is at play here? Is it fear or greed? Well, right now it's greed.
Why? Why do you have to know if what happens then if it's extreme fear or extreme greed? Does that suggest that you're going to have a big sell-off or a big surge?
No, it just suggests whether you're getting it. When do you get bargains? You get bargains when there's lots of fear. Okay, when do you pay full price? When everybody thinks the future is going to be rosy forever. I mean, Warren Buffett says, "Be greedy when others are fearful, and fearful when others are greedy." Okay, so
it's that simple. It's that simple. You look at that index and act accordingly.
But what I would suggest is there's another element. Okay, think about whether Warren Buffett would buy. Warren Buffett's not greedy. If people are fearful, okay, you've got to be greedy about the things that Warren Buffett would buy. So Warren Buffett's not buying some speculative nonsense. So it's no good being greedy about speculative rubbish. Okay, you've got to be greedy about decent businesses at attractive valuations, with limited downside. And that's how you stay in the game. And remember, we've got to get rich slowly. He told us that. We've got to get rich slowly. Don't be out there trying to hit a 6 off every ball. This is not IPL cricket. It's 5-day test cricket we've got to play here. So I would say that we've got to be very careful. There's lots of risks out there. We prepare for some tough times. And if you don't have the stomach for tough times, it's no good preparing and then not having the stomach. So, and the way in which you protect yourself and stay the course is low valuations, I would suggest.
Now explain that. What do you mean by that?
Well, interestingly, Alec, I saw a piece the other day that in the last 100 years, value has beaten the rest 9 out of those 10 decades. Okay, and there was only one decade when value, being applying a value strategy, buying companies at low valuations. The only decade when value didn't win was 2010 to 2020, and that was after the global financial crisis, when interest rates went practically to naught to try and stimulate things. So, it's a winning strategy.
I just want to help those who don't, who kind of aren't with it. When you say low valuations, in other words, it's the intrinsic value of that company, or let's just use a really crazy example, a company that's got $100 of cash in it. If you can buy that $100 of cash for $60, then that's, if the market price is $60, then that's a low valuation. It's very nice. If, however, it's trading at 120 because there's expectations that things are going to be great in the future, then you're paying a full price, or you're paying for future growth. So it's just important to remind people what you mean when you're talking about that. So it's kind of the basic conservative stuff that investors go and learn about, that has mattered in 9 out of 10 decades, which is interesting that it's all in another place at the moment.
Look, there are many valuation metrics, and obviously the price earnings ratio, the PE, a low PE is typically a good thing, but not always. Okay, if it's a low PE but the earnings are about to collapse in a heap, well, then that doesn't help you. So whether it be free cash flow yield, price to book, dividend yield, price earnings ratio, you have to look at a number of these metrics, and then you have to.
Could you just ask AI? Could you say to AI, is this stock low value or a growth stock? Or I'm just thinking about people. Let's say young people. A lot of young people are now waking up and saying, hey, I better start investing young. In my teens, Michael Dell's doing it for how many? 25 million Americans, giving them a start. Would you be able to say to AI, Is this a low value stock or not, or how are you gonna work it out?
I'm sure you can do that. I don't know if it's going to be. I doubt it's going to be fraught with errors, I would suggest. So this comes, the price earnings ratio is a simple metric and an overall basis. So, for example, the price earnings ratio for the S&P 500 right now is about 25.
Which
Okay,
means what?
which means, here's an easy way to think about it. Invert that 1/25. It's like investing your money in the bank and getting a 4% yield. Okay. So it's like getting a 4% yield. Does that sound attractive given all the risks out there? Would you be happy putting your money in the bank and earning 4%? Bearing in mind that comes with risk. You can get 4% in the bank risk-free, arguably. So that's a good way to think about it. Whereas if the price earnings ratio is 10, well, 1/10, it's like investing your money and getting a 10% return. Okay. If a price earnings ratio is 5, it's like investing your money and getting a 20% return. So, those are the kinds of numbers out there. So what I'm saying is that price earnings ratio, I think Walmart is close on 50, 45. So let's just use simple maths. It's like putting your money in the bank and getting a 2% return. Now, you're going to get some earnings growth, arguably with Walmart, but what if you don't? Because the world's so disrupted. Okay. So if you're not getting growth to compensate for that low return that you get, the low 2%, you're in trouble. And that's what happened with Novo Nordisk. People were paying 40 times earnings. That's a 2.5% earnings yield.
Because of the
Putting
fat
your
drugs,
Yeah.
basically.
Okay.
Uh-huh.
So why were they only prepared to accept 2.5%? Because they were expecting Novo Nordisk to grow. Guess what? Novo Nordisk has stopped growing and is reporting declining earnings this year. So all of a sudden, no one wants these things at 2.5% earnings yield, and the share price falls a lot. And so Novo Nordisk is derated from 40 times earnings to 12 times earnings, and you've lost 70% of your money. Okay. So that's the problem with paying too much for growth. If the growth isn't there, then you lose your shirt. If you pay a low price and you don't get growth, well, no one is expecting growth. So you don't lose your shirt. And you hopefully get a dividend. So you survive the tough times. And that's why you want to pay a lower price. Because especially given all the risks out here.
Hence value. Lower
Hence
price
value.
means value.
Yeah.
And
No,
higher
it
price
does.
means growth. Okay.
Yeah.
Got it.
Okay.
All right.
Doesn't mean that it's going to be the winning strategy next week or next month, but 99 decades out of 10, I'll take it.
You told us right at the beginning of the conversation that you got into investing because your father passed away and you had an insurance payout that you needed to find out more about it. Is that, and that was quite a jolt for the family for obvious reasons, and quite a jolt for you as well. Is that, in the absence of that, what would make somebody, or what would turn somebody into becoming a conservative, smart, careful investor, which you've shown is actually clearly the best way to be, because your performance numbers are just off the charts relative to your competitors?
Well, you know what they say, Alec, you get old investors and you get bold investors, but you don't get old, bold investors. Okay. And that's because the old, bold investors got blown out the water. So at some point, and that's the problem. Remember, if you put all your money on black and black keeps coming up because you've taken concentrated bets, well, eventually when red comes up, it doesn't matter how many times you've bought on black, you've won on black. So, the way to do this is, it's a bit like, think about a rugby game. You make some advances, then you consolidate, and then you kick the ball and you advance further down, you consolidate, and eventually you score a try. But if you're just kicking the ball wildly all over the show, you can get a counterattack and lose. So you want to be conservative, I think.
And the way to be conservative is to go where the benefits have accrued most. And as you say, that's when you're buying for 9 decades out of 10, you're buying into stocks that are trading less than their true value. You're not buying into a future hope. You're actually buying the fact that this is, you've got substance there. And it seems to make sense. I mean, that just seems like the way we live life, or should live life anyway. Don't take a chance. To make sure that you know what it is that you're paying for.
Well, look, that's absolutely right. So why doesn't everybody do it? Well, sometimes those risks manifest. Okay. So we were buying some software stocks. last month. We're not all, we did our work because some are going to survive and some we are going to have tough times. Now, if you bought software stocks and you got it wrong, well, your clients are going to look at you and go, but hang on, but everybody knew AI was going to disrupt software stocks. What are you doing buying software stocks? Okay. So people don't want to be in that position in case they get it wrong. And then it's like, well, hang on, didn't you know that you didn't want to buy airlines? I mean, the oil price is high. Why do you want to buy airlines? Everybody knew airlines were going to fall, So it's a tricky thing. You got to be prepared to say to clients, look, we're not going to get it right all the time. We go where we think the value is, and sometimes we get it wrong. But what the key is to get it right more often than you get it wrong, and to win more when you get it right than you lose when you get it wrong. That's the key. And then you compound that through time. So it feels difficult, and it's like straying from the herd. I'll tell you a funny story. I used this analogy once, and I said, if you're we're all antelope out in the field, out in the savannah, and we can eat the grass underfoot. Okay, but it's trampled. So you want to go and eat the juicy grass to the left. The problem is that the juicy grass over there is where the lions are lurking. They're hiding in the bush. And so I said, what you want to do is you want to wait until the lions have finished feeding. Okay, and then you go over there. And I was telling the story to this one friend of mine. He says, you clearly know nothing about wildlife, because I've got a client of mine who is a game ranger, and he'll tell you, even if the lion ate 5 minutes ago, if an antelope walks past, you can have another go because he's not sure when he's going to eat again. So that's my point. The juicy grass is away from the herd, but we are herd animals. It feels safer to be in the herd.
Sean, you've given us a wonderful masterclass in investing, and thank you. That's the kind of thing, the kind of conversation I hope that people will come back to time and again. But where we are right now, mid-April, where is the grass the greenest? And where are the lions lurking that you need to watch out for?
We think we like Asia and select Europe. And you think about what sectors are out of favor. Healthcare is very out of favor. Energy's been in favor. So maybe you want to be careful about being in some of the sectors that are very much in favor, and go and use that as a starting point. And stay away from the popular stocks, because when the pawpaw hits the fan, everybody owns the popular stocks. Well, that's what people are selling to raise liquidity. And maybe that's why at some point Microsoft was down 26%, year to date. So it doesn't matter how big this company is, how wonderful it is, you can get trampled if you're in the wrong, if the herd changes direction and you're there.
So many of these stocks, though, have been running for a long, long time. The Magnificent Seven. Okay, Microsoft's had a bad bump, but Amazon has been growing in the last couple of weeks, again, because of new excitement, new ideas that they're putting on the table. When do you feel that it's the time to get off those trains? Or do you always keep a little bit on those trains while you're looking for more attractive propositions?
Well, the one thing we do is we pretend we're in cash. So with any stock we own, okay, and we say, if we didn't own the share, would we buy it today? If you were completely in cash, would you buy Nvidia today? Fresh position. And that often brings clarity to your thought process. You go, hang on, I wouldn't buy it up here, or whatever. Look at Netflix, down post the results. Look at Apple, changing CEO. There's always changes happening out there. So even if you thought Tim Cook, he's done amazingly. He's been there, 15 years, and I think the stock's up 20 times since he took over. Everybody was worried about Steve Jobs, and then Tim Cook did a fantastic job. Well, what now? So there's always changes, Alec, and I think a good starting point is, say, if I was in cash and I didn't own it, because there's a thing called, and it's behavioral finance, it's a thing called the endowment effect. You value companies you value what you own more than if you didn't own it. All right. So if you've already got Nvidia and it's done well and you've been profitable and it's treated your portfolio well you're very well disposed towards Nvidia. And so there's the endowment effect. So you might think, I don't want to sell Nvidia. But if you say, well, pretend I didn't own Nvidia, Would I buy NVIDIA here? Assuming I have none of that history, you might say, ooh, not so sure. I'm expecting the future to continue to be like the past. And now some people will say, no, but NVIDIA is on a lower price earnings ratio than it has been historically. Well, remember, there's a very important point here. And that is its price. A price earnings ratio is your price divided by your earnings. If your earnings are very high, okay, your price earnings ratio could actually be lower. But you've got to be careful to put a low price earnings ratio on very high earnings. So there's more competition coming down. We've seen what Amazon's doing. We've seen what Alphabet's doing, the chips in China. People are coming for NVIDIA's lunch in the same way as the obesity drugs are coming for Novo Nordisk's lunch. So be careful out there because it's been good for a while.
Talk about drugs, you've got generics as well. Sean, one last point, and I've really used up a lot of your time this week, in this conversation, but you also pay a lot of attention to the detail. Do you look at things like the SEC filings, or what we would have here in South Africa, the SENS reports? Do you look much at
absolutely?
And what's there? What's in there?
Well, so for US stocks, you have a 10K, which is the annual report. You have the proxy, which is how what they're doing for remuneration. Well, you see that in the 10K as well, and what they're voting on. Then you've got your quarterly reports, your 10Qs. Okay. And there's all sorts of things for comparing the risk factors. So there are new risk factors that they've introduced in this year's annual report that weren't in previous annual reports, for example, and you can use AI to do that. It gives you segmental breakdowns, but it's astounding how few investors read annual reports, and they'll kind of read the SENS announcement and then move on to the next thing. And well, what is the CEO saying? What is the chair saying? So yeah, those SEC filings are very important. Are they raising debt? Is there a new prospectus out because they're raising debt? What are they going to do with the debt that they've raised? Lots of information in those. And you're kind of going where other people don't go. So there's some staggering statistic about what percentage of investors read the annual reports. And so annual reports are very important. Quarterly reports also important because, the annual report might have been written 9 months ago and things could have changed. So you got to have a look at the latest quarterly reports to see how things have changed. Conference call transcripts are also good because they're unscripted. So, the annual report, what the chairman or CEO has said, has been through 3 rounds of legal checking. Whereas if the CEO is answering a question at a conference, the lawyer hasn't had time to check what they're going to say in many cases. So, yeah.
We're in the quarterly report season now. And just to close off with, what should we be looking for? Is there anything in particular when, let's say, Microsoft, you mentioned it earlier, when its quarterly report comes out, it's done to death, earnings up, earnings down, beat the street, didn't beat the street, etc. And beating the street means just what analysts' expectations are on average for those results. So what should we be looking for?
Well, we don't worry too much about beat the street or miss the street. What they do is you'll see the headlines. So first of all, companies will guide. They'll whisper to the analysts. They used to talk about a whisper number beforehand, like, they've seen an analyst has got $3.20, but Microsoft knows they're likely to come in a little bit less than that. They'll go, what are your assumptions? And they'll kind of communicate it. And so people will bring down their estimates ahead of the results, and then they beat the number. And then it's like, oh, Microsoft's beaten the estimate. Okay, but it's also, how did they beat the estimate? Did they beat it because of operating income being margin widening, or did they beat it because they assumed a lower tax rate, or did they beat it because they didn't they got some extraordinary income from the sale of some of their OpenAI shares or whatever? It's how did you beat it? So it's the second level thinking. Not just say, well, you beat the estimate. Well, yeah, what was the estimate before? Had the estimate been rising or falling? Then how did they beat it? Was it better than expected revenue, better than expected operating income? So you got to look at deeper, second level. How did they beat it?
And also stick to your guns. Yeah, because you've done the homework.
It's the Howard Marks thing.
Yep.
Second level. And then I think the big thing for the tech companies is going to, if you are a software company and you're disappointed with the software AI fears, it's going to be interesting. So the key factor, obviously, which has been plaguing the Mag 7 has been what their capex commitments have been. And they've all been committing to higher and higher capex and have been borrowing money off balance sheet so that some of the capex spend doesn't stay on balance sheet. So those, I think, are pretty important. Also, what's the strength of the consumer, maybe, and inflation. Those are going to be interesting things to look out for. We've had the banks. Some of the banks did well because of all the volatility in March. So being some good trading. And so now it's going to be, so the next few weeks are going to be very interesting in the US.
Just shows as well, as we know from this conversation, that what you do is highly complex. It takes years and years and years of focused attention to build up the level of knowledge that you have, and you so willingly share with us, Sean. We're going to miss you in the Berg, but thanks again for this conversation. I'm sure you'll be back at BNC 9, which will be in Hermanus in March next year. But and I'm pretty sure we'll have a conversation long before then. But thanks again, and let's just hang in there at this time. Follow the basics, and don't get caught up by the narrative and by the herd. That's kind of the message I think you're giving us.
Watch out for the lions.
Watch out for the lions. I'm Alec
Thanks,
Hogg
Alec.
from BizNews.com, and we've been talking with Sean Peche, the founder and Chief Investment Officer of Ranmore.